payoff and the profit and expiration of a call. Now, so this time the S big T, so which is the spot price or stock price, all right? So let's use stock as an example. So in here, everything we are talking about is stock, all right? So ST is the stock price or the stock spot price at maturity, at time T, big T. And E is the strike price or the exercise price. Now, the payoff to the call holder at maturity will be positive. We know that when the spot price is greater than the exercise price, the strike price, you make money, all right? Your payoff will be just equal to the difference between the two. So in our TV example, if the TV price now is 1,500 and your strike price is 900, your payoff will be 600. But your profit and loss will be only 500 because you put down a $100 deposit, which is the premium of the call option. All right? Now on the other side is the call writer who sell the call to you, or the one who sell a call. So we call it call writer. So the call writer, the payoff will be exactly the opposite of a call holder. So this is a zero-sum game. So that means if the price of the underlying asset is higher than the strike price, the other party will exercise the call option. Then you have to sell this underlying asset at a loss. Because the market price is 1,500, you have to sell at 900. Because the other party, they have the right to buy at 900. So your payoff will be negative 600. So let's say you don't have a TV. Then you go to the market, you buy a TV, you pay 1,500, and then deliver the TV to the call holder. And the call holder will only pay you 900. Alright? So your payoff will be 600 negative, but don't forget you received the $100 deposit. So your P&L will be the payoff plus the premium you received at the beginning. Okay? So this is the payoff at maturity. So let's assume the exercise price is $50, and if the stock price is more than 50, the call holder will have a positive payoff. Now, if the stock price is below 50, the call holder will have a zero payoff. You just walk away. Okay? Now, this is the payoff to the call writer. It's exactly the opposite. Now, if we have the same scale on the x-axis and the y-axis, and each option we have one underlying asset, then this will be a 45-degree line. So this one is negative 45. The other one is positive 45. Now, if you have, let's say, if one option has two underlying assets, then the slope will be steeper. Because for every $1 increase, this time you have $2 more of payoff. All right? So in this course, we always assume one option, one underlying asset. Even though in real life, when you go to, let's say, MX, Motor Exchange, you buy option, or you go to US, you buy option, one option contract represents 100 underlying stocks. All right, but in this course, we always do one option, one underlying stock to simple everything. All right. So let's assume if the option premium is $10, assuming the option premium for call and put for this call is $10, then you can see the seller or the call writer, their P&L will be moved up by $10, right? And the holder, their P&L will be moved down by $10 compared to the payoff, because you add or subtract the premium. Now to replicate this, we can just use this one as an example. So this one is, I post two files. One is for payoff, the other one is for P&L, all right? So assume that, let's say, now there's several options available here. 46C, that means this is a call option with a strike price of 46. 47C is another call option with a strike price of 47. 48C is a call option with a strike price of 48, all right? And the maturity is 6 months, half a year, all right? And so I also have risk-free rate, that's 3%. The volatility is 21, and I will talk about that later on. And the stock price today is 50, right? The stock price today is 50. So let's say I want to buy one at the money call. So what you need is just enter one here. Oops. Number lock. So I enter one here. So you can see this is your payoff at maturity. If the price is 52, you have $2 payoff. If the price is 54, you have $4 payoff. So that's why 45-degree line. Now, if one option, let's say if I buy two, okay, so let's say if I buy two call option, so this time you can see, now, although it doesn't look like this, but if you check at this one here, if the price increase by 5, my payoff will be 10, right? Because now I have two contracts. Okay, so this is not a 45-degree line, but it looks like 45 degrees because I don't have the same scale on X and Y axis now. Okay? Let's come back to 0, right? Nothing here. Now, if you look at profit and loss, same thing. If you want to buy a 145 call, a 50 call, so now this is your P&L. So this is your, if you look at this is $3.32. So that means this call will have a price of $3.32. That's the call premium based on Black-Scholes formula. Now we'll talk about the Black-Scholes formula next week. All right, so this is based on Black-Scholes formula. The price of this call should be $3.32. All right, so you only make money if the price is higher than 53.32, because you need to have enough payoff to cover the premium you pay for this call option. All right, so if the price is less than 53.32, you lose money. If the price is higher than 53.32, you make money. Okay, all right. Now next we look at, we'll just go back to 0. Look at the payoff to the call writer. Now this time let's look at 47 call rather than 50. So now you sell one of it, so that's -1. All right. So now this is your payoff. If you short or you sell or write a call option with a strike price of 47. So anything higher than that, you will have a negative payoff. Anything less than that, you have a 0 payoff, because this option will expire out of the money. All right? On this side, the option will expire in the money. So in the money means the holder will make money, then you lose money. Okay? Now let's look at the P&L. This time again, let's try 47C. 47 call, a call with strike price of 47. So now this is -1. Now this time you will make money. So this price now is $5.07. Right? So this price of this 47 call is different from the price of the 50 call. Right? So this time the price is $5.07. So if the price of this is less than 47, you will gain $5.07. Now you will gain less if the price is higher than 47. And you will lose money only when the price is about $52, right? Which is 52.07. Right? If the price is higher than 52.07, you lose money. Okay, right? Let's just go back to 0. To 0. All right. Now next, we look at the payoff and profits at expiration of a put option. Okay, now this time the put option will be in the money when the spot price or the stock price is less than the exercise price. Because now you can sell at this price and the market price is only this. So even you do not have the underlying asset, you can just go to the market, pay this price to buy it, and you sell it at this price, your strike price. Okay? Now the payoff to the put writer, again, is the opposite, is negative of that. Right? And your P&L, profit and loss, will be either up or down, depends on you are a caller, or a put holder, or a put writer. Alright? So this is what it looks like. So this is to long put. So when you long put, you have a positive payoff when the price is below the strike price. Right? If you short put, now you have a negative payoff if the spot price or the stock price is below the strike price. Right? And your P&L just move up and down. Here we assume is $10 each. Okay, so now what we can do is I can show you, let's say this time, let's say I have a $50 put option. $50 put option. So the strike price is 50, so I have one contract. Now this is your payoff. Right? You make money, again 45-degree line, because I have the same scale, I think. Yeah, I think I have the same scale. Yep. So this one should be 45-degree. Now in this case, you can see for call option, your upside potential is unlimited, right? Because you always call option is go this way, all the way, unlimited. But if you long a put option, this time your upside potential is limited, because stock price cannot be less than 0. Because here is like 40, but don't forget when you go up to 0, so if we eventually hit your y-axis, right? Stock price cannot be negative because of the limited liability. Alright? Okay, so seems like this one goes to 0, but no, we still have $40 up there, all the way. You can go up, but always just up to the maximum gain you can have is just $50. Right? So the intercept to the y-axis should be at 50. Alright? So if you look at the P&L, so this time 50 put, you buy one, just one. So now you can see the price is $2.58. Right? So the price of this put option, or the premium of this put option, is $2.58. Now, if you compare this price to the call option, they are different. Remember, call option is $3.23. Remember correctly, $3 for something, right? But this is only $2.57. They have the same strike price, same maturity, right? Both are 50. All right, but one, well, I can put it right here. I can add another one here. I can add the $50 call. So you can see, right? The gray one is the put option. The green one is the call option. Now, if you look at the price, they are not the same. They are not the same. Now, the black one, I will talk about that in the black one, which is what we call the straddle, right? So we will talk about the black one, but just look at the two individual, all right? They will not have the same price. Now, the reason why they do not have the same price is this risk-free rate. So if you set the risk-free rate to 0, then both will have the same price of $2.96. Okay? The reason why they are not the same, the call option, put option, they do not have the same price, is the risk-free rate, the interest rate. Okay, so we will talk about more about this interest rate, so let's go back to 3%. All right? Now, what we want to know here is about stock investment versus option investment. Option investment actually is a leverage investment. It is higher risk than stock trading. Okay? Now, even I myself and a lot of my friends, once they start trading option, they never go back to trade stock anymore. Because it's more fun. Well, when we talk about trading, not investment, right? Investment definitely is long term for your retirement. You may invest in stock or blue chip or some kind of ETF, mutual fund. But for trading, you want volatility, you want leverage, you want excitement, all right? But once you start trading option, then there's no turning back, right? Because now you trade stock is kind of boring, right? So let's look at this example why option is so more leverage in the trading. Okay, let's say you buy, let's say, a stock with a market price of 50 today, right? With a $10,000 investment, you can purchase 200 shares. Okay. Now let's assume there is an at-the-money option. Let's assume a call option, and each of them has a price or premium of $5. So with the same investment of $10,000, you can purchase 2,000 options, right? Because it's $5 each. Now let's look at your return at different future stock prices. So let's say at maturity, this stock price dropped it to 45, right? Now if you invest all $10,000 in stock, okay, yeah, please sign your 10. So if the price drops to 45, you own 200 shares, that value will be 9,000. So your return will be negative 10% because you invest $10,000. At the end, you have $9,000 worth of stock. Okay? But if you look at your option alternative, you invest the same amount, but today is zero because this option will expire out of the money. Right? The strike price is 50 and the stock price now is only 45. So this option will expire out of the money. So it's all gone. Right? So your loss will be 100%. Now if the stock price is $50 or $55, then your stock holding will be worth 11,000, which is a 10% return compared to your investment of 10,000. Now your option investment, now this time each option will have a $5 payoff because the strike price is 50 and the stock price is 55. So each option will have a payoff of $5, all right? So that means you will get $5 times 2,000, which is $10. So the same as an investment, so your return is zero. You break even. You break even at this point. Now, if the stock price is 65, your portfolio of stock will be 13,000. 65 times 200. But for option, this time each option will have a value of 15. 65 minus 50, which is 15. With 2,000 option, that will have a value of $30,000, which is a 200% return. So you can see if you invest the same amount in stock, well, under this free scenario, your return is from negative 10 to 30. Now, but if you invest in option, this time your return will be negative 100 to positive 200. All right? So that's what we call leverage effect. You actually magnify the return by trading option. So that's the reason why the SEC, they restrict mutual fund investing in option futures. Right? Because they think, oh, mutual fund should be for small investor, for their 1001K or your, let's say, RSP investment. Right? Now this is stock option quotation, and so that's this BNS Nova Scotia, right? So the price was $79.31. So this is the last trading price, and they have the call and put together. But let's just, okay, so you can read it, but let's look at some real world example, right? Okay, so this is what we have. Now just look at some of them. Now if you trade, let's say if you buy stock in Canada, let's say Royal Bank for example, right? Then you have to go to MX. Now MX show you, this is what we call the straddle view. The straddle view, that is, they show both the call and put side by side. So that means, let's pick one of it, okay? Royal Bank, the current price right now is 160, this is Canadian dollars. So if you're trading Royal Bank in US, it's about 111 or 110 something, right? This is Canadian, 160 Canadian dollars, right? So this is the mass market price. Now, let's look at, let's say 150, let's say 160, let's look at 160, okay? This is 162, 160. Okay, so this is 160. I mean, this is this is called at the money, very close to the market price, 162 something, right? Okay. So if you look at this, is the price of a call. This is the price of a put with the same strike price of 160. Okay. Now this one, this is the bid price and ask price. That is, if you buy this option, you have to pay $1.78. So one contract is 100 shares. So that means if you buy one, you have to pay 178. All right. Now, if you sell this call option, you only get 155. All right. So this is the last trading price, 178, and this is compared to yesterday's closing. Now, that's two other information. This is the volume, 30. So it means today up to now, there are 30 transactions on this contract, right? Either buy or sell, long or short. Total 30. Now the open interest, it is the number of outstanding contract yesterday closing. So that means yesterday closing, there were 185 contracts active. That means they did not close the position. So let's say, for example, if you buy a call, 160 call, so you pay 1.78 today, right? So 100, that's 178. Now, the number of volume will increase to 31, if you buy 31, all right? But the open interest will remain the same because it was yesterday open interest. Now, if by the end of the day, we already passed. Okay, anyway, but let's assume you close this position by the same day. So you sell this call option in the next minute, all right, in the next minute. So this time, you get 155, you lose money. You lose about $23. Now, the contract this time will increase to 32. The volume will be 32 because there's no two contract trading, all right? But the open interest will stay the same even when we close the market today. Because you open your position, you close your position. So the open interest stay the same. But if let's say you open a position